Welcome back to this week's Manager's Thoughts, coming to you from Kelly at Synergy Asset Management. Today is March 31st, 2023, quarter end here. Let's get right into it. So with quarter two wrapping up here, wanted to review where we are at in the markets. These are all as of Thursday, March 30th, year to date. The NASDAQ remains on top here, up about 16.05%. The S&P remains up about 6.3%. The Dow Jones is basically flat here, and the 10-year U.S. Treasury yield has taken about a 5.8% hit so far year to date. Definitely an interesting movement in the markets. I'm not sure if anyone would have guessed that the NASDAQ is up so much, that we've rebounded so much in those big, large cap tech stocks, but definitely interesting movements here that we will continue to monitor. Moving into some market news of this week, the Senate Banking Committee held a hearing on the recent regional bank failures, questioning the FDIC Chair Martin Gruenberg, the Fed Reserve Vice Chair Michael Barr here, as well as the Treasury Secretary of Domestic Finance, Nellie Liang. All three were really echoing the same sentiment that the bank failures were ultimately caused by poor risk management and bonus-hungry executives, along with the lack of a chief risk officer at SVB for about 8 months during its extreme growth period. The hearing also revealed that SVB faced over $140 billion of withdrawal requests out of their $175 billion of deposits just within the 2 days prior to the bank's failure. SVB was also revealed to have a total regulatory CAMELS rating of 3 on a scale of 1 to 5, with 5 being the riskiest sort of bank. What's really interesting about this, though, that even though the bank was quoted to be somewhat risky, the liquidity rating, which was the bank's major downfall, was only at a 2, meaning that it was at just a small, moderate risk to regulators. On May 1st, we look forward to getting a full release of a comprehensive review on the recent bank failures, along with any recommended changes in supervision and regulation by the FDIC, the Fed, and the Treasury. Shifting gears a little bit here, we got the PCE inflation data on Friday morning, as February PCE inflation came out at an annualized rate of 5% here, while core PCE came to 4.6% year over year. So just a slight tick down from January. On a month-over-month basis, PCE actually fell 0.1%, while core PCE increased about 0.3% in February. Along with the PCE inflation report on Friday morning, we also got the personal income, spending, and savings reports for the month of February. So we saw personal income jump a higher than expected 0.3% here, while personal spending increased a lower than expected 0.2% in the month of February. Consumers' personal savings rates increased to 4.6% from January's 4.4% rate, and this is because they're becoming increasingly aware of this difficult macro environment. As you can see, especially when comparing to August of 2022, the personal savings rate is more than a whole percentage higher now than it was just about 6-7 months ago. This week, the Conference Board reported March's Consumer Confidence Index up to 104.2, just slightly up from February's 103.4 index. The survey included responses up to 10 days after the failure of SVB Bank, which I found especially interesting because it basically proved that the quick actions of the Fed, the FDIC, and the U.S. Treasury seem to have calmed different consumers and their confidence in the economy, their confidence in the banking system, and that shows in this index. Even though the index is definitely below where it was pre-pandemic, it is certainly not at those lows of March of 2020. One final update of this week, despite higher interest rates and despite, it seems like rounds of corporate layoffs are happening every day, initial claims data is actually still demonstrating a pretty tight labor market. So on Thursday, initial claims data for the week ending March 25th posted a pretty slow 198,000 initial claims, only about 1.5% higher than what was estimated. So you can see that right there. We're really in a pretty low territory of initial claims, and obviously that means pretty low unemployment as well. This actually pulled the 4-week average down slightly, and next week we're going to receive more employment data when the March jobs report comes out next Friday. Only time and more data will tell how labor markets are really doing and how the interest rates will impact the labor market moving forward in the midst of this economic uncertainty. So we look forward to continuing to monitor the employment situation. As always, even through all of this economic data, Senate hearings, Synergy is constantly watching the news, constantly staying updated with these events so that we can best manage each of our portfolios per their mandates. We really appreciate you tuning in this week for our Synergy Manager's Thoughts update, and we look forward to providing another update soon.